Did you know that one of your losing investments could actually save you thousands in taxes this year? Welcome to the Lawyer Millionaire, where we deliver financial planning insights and business strategy for ambitious law firm owners so you can enjoy more time, more abundance, and less stress, even if you're still growing your law practice. Here's the scenario. You've got some underperforming stocks sitting in your investment portfolio, and every time you look at them, you cringe. What if I told you that those losses could actually be one of your smartest tax saving moves? In today's episode, we're diving into tax loss harvesting. Woohoo! A simple strategy that can save you big on taxes while keeping your financial plan on track. First, let's define tax loss harvesting. What is it? This is the process of selling investments at a loss to offset gains in your portfolio in other holdings or even reduce your taxable income. This strategy applies specifically to taxable accounts. So if you're thinking about your 401k or IRA, this isn't going to be the right tool for that. But here's how it works. Losses from one investment can offset gains in another. Let's say you bought a stock and it's done great. You bought Tesla, it has soared through the roof. And then on the other hand, you bought Bed Bath and Beyond and it has just plummeted. You lost 10,000 on Bed Bath and Beyond. You gained 10,000 in your Tesla stock. If you sell the Bed Bath and Beyond stock, you can take that loss, use it to offset the gain on the Tesla stock. Fantastic. And then you won't owe any taxes on the gain in the Tesla stock. Now, if your losses exceed your gains, you can deduct up to $3,000 off of your ordinary income annually. And if your losses go even beyond that, you can take the leftover amount and carry it forward into future years. So it really behooves you to take your losses, to harvest the losses. Even if you don't think you're going to use them, it's a tax savings just sitting there waiting for you to use it, right? And this can be very, very helpful if you are a law firm owner and you have fluctuating income. You can use tax loss harvesting strategically to give you some savings in some of those high income years. And you know what? What's great about this? It's not just about taxes. It's about turning a financial setback into a smart win. All right. Now, why does this matter? Well, I'll give you two illustrations to share how impactful tax loss harvesting can be. First, anybody remember BlackBerry? And if you don't, well, you're very young. The BlackBerry was the iPhone, pre-iPhone, right? It was the thing. It was the cell phone that everybody had for business. I never had one. I will admit that I'm a little bit too young. They were around, but anyway, we're going in a different direction than we need to. But the BlackBerry, right? It was at one time the phone of choice for business, and they kind of went by the wayside. And their stock did really, really well, of course, during the tech boom, and then obviously plummeted. Well, we have a client who owns BlackBerry, and we were talking with this particular client about that particular stock. And this client also has a large brokerage account with other investments, a taxable investment account. We were talking about making some adjustments, some changes to the holdings in that investment account. But we were like, wait a minute, we got to think about taxes, because if we make these changes, we might have some capital gains that we'll be subject to. Because if we sell this stock over here and this fund and buy this other fund instead and make some adjustments, we might end up facing some capital gains taxes. Well, hallelujah for having BlackBerry, because here sits a bucket, a treasure trove, if you will, of tax losses that can be harvested, right? And so we could potentially use some of those tax losses to offset gains, make the adjustments that we need to make, and not have extra taxes to pay. So there's one example. I'll give you another example. One particular client of ours is a very sizable investment account, taxable, most of his money in taxable investment accounts and directly in stocks like Apple. And we're talking mega cap growth stocks like Apple, Facebook, Nvidia. Household names, right? Well, here's the problem. These stocks have built up huge unrealized gains. And so an unrealized gain is a gain you haven't taken yet. You haven't sold the stock yet. It's built in, right? If you sell it, it becomes realized. And so, that could be a problem down the road because when you go to sell them, you're all of a sudden going to have all this additional income. It's going to affect your tax rates. It's going to affect everything. So, a smart plan would be in that type of scenario, you have some concentrated wealth in some concentrated stocks to take losses from other parts of your portfolio and use those losses to offset some gains and harvest some of those gains and profits over time so you can reduce the future tax impact if you ever do decide to sell those stocks in the future. I mean, how would that work, right? Let's say you have 5 different stocks, okay? You sell a little bit of stock one, you've got a gain, sell something else from another pile that's a loss, offset the gain. Buy one of your other 5 stocks, okay? And then kind of do that process every few, once a quarter or something like that, and try to, reduce those unrealized gains that are built in there. Let's break down how tax loss harvesting actually works. So here's what you want to do. And this is a great thing to be doing and thinking about as we come in to the end of the year. And that's why we're talking about this. Review your portfolio. Start by identifying investments in taxable accounts that have built-in unrealized losses. These are assets that have lost value since you bought them. Now, there may be other things that skew the losses or gains, like dividends or distributions, but pretty much that's how it works. Number 2, then obviously, you're going to sell the investment. When you sell, the loss becomes realized, which means you can use it to offset gains from other investments or reduce up to $3,000 of ordinary income. Now, you may think, oh, $3,000, that's not very much. Well, if you're in the highest bracket, if you're in the 37% bracket and you can reduce your income by $3,000, you end up saving over $1,000 in taxes. I mean, I don't know about you, but I'd rather not pay an extra $1,000 in taxes, right? Once you've sold the investment, then reinvest strategically. And here's the trick. Don't leave that cash sitting idle. Reinvest in a similar but not identical investment to maintain your portfolio's balance. Okay, so the IRS says you can't repurchase the same or a substantially identical, and that's critical, investment within 30 days. So you can't sell Tesla and then immediately rebuy Tesla and get the tax loss. All right. You can't sell an S&P 500 index fund and immediately turn around and buy an S&P 500 index fund and get the tax loss. I mean, you could, but you could claim it. But if the IRS audits you, you'll get in trouble, right? What you actually want to do instead is buy something that is substantially different, similar, but different. So another stock fund that has similar characteristics, but it's different enough, right? It has a different strategy, has a different mix of investments. If you sell Tesla, buy a large cap growth fund that has Tesla in it. I don't know why Tesla's the stock of the day, but it is. If you sell one large cap growth fund, buy a different large cap growth fund that is actively managed and maybe has a different investment strategy, right? Even if you don't like it, let it sit there for 30 days. Then you can go back and you can buy the original investment. But you got to wait 30 days before you go back and buy the original investment. Otherwise, you get caught with a wash sale. So the IRS calls this a wash sale. It invalidates the tax deduction. And instead of getting the tax loss, they're just going to carry that forward into your basis when you repurchase, right? So you got to wait 30 days. Buy something. You don't let your money just sit in cash. It's time in the market, not timing the market. You want to buy something similar, but different enough that it wouldn't be disallowed by the IRS. So, great. That's tax loss harvesting. It's a way of taking advantage of pieces in your portfolio that maybe have not panned out. Instead of writing out a loss, you can actively put it to work for you. And here's the thing, right? This makes a lot of sense. I'll give you a Wall Street nugget, okay? An old Wall Street adage says, cut your losses or cut your losers and let your winners run, okay? And it really is a great, simple piece of wisdom in investing. And we're not talking about the market, we're talking about individual stocks, right? Individual stocks that are just trailing the market, are not doing well. Losers tend to stay losers. This is pretty much reality. A lot of folks will, try to pick losers that can reclaim winner status. That's hard to do, folks. Um, by and large, for the most part, most of the time, losers tend to stay losers, and winners tend to stay losers. Winners tend to stay winners. Let me get that right. Up to a point, right? So your stocks that are really going, they're really taking off. Yeah, they do attract their haters. They really do, but they tend to keep going. Now, there does come a time when usually the party ends, but winners tend to keep that momentum. Think about Apple, right? It's been a winner for a long time. There was a period of time where it struggled, yes. Um, so when you're doing this, it is kind of a way of letting giving yourself a reason to let go of the losers in your portfolio. Sometimes we want to hang on to the losers because we believe that they're going to come back. They're going to make a comeback, and they can, but sometimes it can take a long time, and you could be missing out on other things. I have a great story about this. My dad, right, bought a company during the tech heyday, Canadian company that creates healthcare technology, and they did great. I remember him telling me the stories, right, when we were driving to school. I was a middle schooler at the time. I'm giving away my age. And he was telling me, oh, the stock is going nuts. It's going through the roof. And it was, $10 a share, $20 a share, $30 a share. And then the tech bubble burst and the stock dropped to, I don't remember exactly, a couple dollars a share. I mean, and Dad, to his credit, he hung on to it. And I don't think it ever went back while he owned it to exactly where it was. I think by now it has. I mean, it's been 24 years, right, since that event. For a long time, it did nothing. A long time. Eventually, it did make some money for him. It made quite a bit of money, but it took decades. It took, well, yeah, it took 2 decades, right? It took a while. It took a long time. And meanwhile, there were other opportunities and other stocks that he often thinks, oh, if I had only bought Microsoft or, something like that. So losers tend to stay losers. Anyway, enough Wall Street wisdom for the day. Let's talk a little bit more about tax loss harvesting and timing. So a great time of year to do this is at the end of the year, because the deadline is 12/31. It should be something you're looking at before the end of the year. But also, it should be something you're looking at throughout the year, because if you have a stock in your portfolio and it drops like a rock at some point during the year, now granted it may bounce, and you may regret selling it. I wouldn't sell something that drops right away, because there does tend to be reversion to the mean and the bounce effect, right? But if something just it's petering out, it's falling in mid-year, that might be a good time, right, to take advantage of that. So it's something that you should be watching for throughout the year. Okay. It's also something that you should be looking at in those years where you've had gains elsewhere. If you're selling a profitable asset like a piece of real estate or highly appreciated stock, tax loss harvesting can reduce or maybe even eliminate those capital gains. And it gives us a great opportunity, as I mentioned before, to get rid of the losers and diversify and rebalance and redirect into other investments. Okay, so what can you do to take advantage of tax loss harvesting? Let's simplify this. Number one, you should be doing this before the end of the year. Review your accounts, look at your taxable accounts, identify any securities with unrealized losses. Consult your advisor. Number two, the strategy can be complex, especially the wash sale rule. You want to make sure you don't run afoul of that. A financial planner can help you with that. Number three, sell strategically, execute the sales to realize the losses, and make sure that aligns with your financial plan. And number four, reinvest wisely. Use the proceeds to maintain your portfolio's growth. Find something similar, but substantially different. Tax loss harvesting might seem like a small thing, like I mentioned, and something that won't make a huge dent. But the truth is, a lot of small things in tax planning can add up to huge tax savings, both in the present and long term. And while you might think that you have all kinds of other things to worry about, this is something you should think about because it can have such a big impact on your taxes today and in the future. And this ties directly into the bigger picture of financial planning, which is what we do here at the Lawyer Millionaire. Wouldn't it be great if someone was watching out for those opportunities for you so you could focus on running the business instead of things like tax loss harvesting? That's what we do. We become the eyes and ears around your finances 24/7 so you can focus on the things that will drive revenue and profit in your business. That's what we're here for. Schedule some time with me to review your portfolio and uncover hidden opportunities to save on taxes and maybe optimize your strategy. I'll put the link in the show notes to my calendar. Schedule some time with me. Just go right down there and click on it. It'll take you right to my calendar. And together, we'll create a strategy that aligns with your goals and maximizes your financial potential. This has been the Lawyer Millionaire Podcast. I'm your host, Darren Wurz. Thank you so much for joining me on this journey to expand your business, maximize your profits, and secure your financial future. I can't wait to connect with you again next time. Until then, take care and keep pushing forward.